In this lecture, we handle the other lease classification outcome, the operating lease. This is the lease where the rental really is a rental. The lessee borrows the asset for a small portion of its useful life and gives it back with plenty of value remaining. The accounting goal is different here, and once you see the goal, the mechanics fall right into place. We want the income statement to show one smooth, level rent expense, while the balance sheet still tells the truth about the lease transaction. Now, if you've been paying attention to the story of this chapter, the phrase operating lease should make you a little suspicious. Wasn't the operating lease the villain of the original lesson? The invisible lease? Here's the thing to get straight right away. After ASC 842, operating no longer means invisible. The operating lease still goes on the balance sheet, asset and liability, present value, the whole treatment. What changed is only what happens on the income statement. The loophole is closed. The label survived. In fact, the accounting for an operating lease sometimes surprises students. At inception, the journal entry to record an operating lease is identical to the finance lease entry. Debit right of use asset, credit lease payable, both at the present value of the lease payments. Same entry, same numbers, same amortization table for the liability. The difference in classification only affects the income statement. A finance lease gives us two expenses, interest plus amortization, but an operating lease gives us a single lease expense, the same amount every period, straight line. It looks like plain old rent expense because economically that's what it is. Here's the way I want you to think about the operating lease expense. The total is decided first. Lease expense equals the straight line average of the payments, what we agreed upon in the contract. In our example, simply the annual payment. That's the number that hits the income statement, period. But behind the scenes, our balance sheet accounts still need to move correctly. What I mean is that we still want the lease liability to slowly decrease over time until it ends up at zero at the end of the lease. Normally, we use an amortization table to figure out how much of each payment represents interest expense and how much goes toward paying down the principal balance of our liability. But in an operating lease, we don't allocate each payment to interest and principal. We recognize the entire payment as an expense. We can still use our amortization table to figure out the rest of the entry. Although we don't need the number for interest expense anymore, we can still use the amount that would have been allocated to principal to slowly decrease our lease liability and right of use asset over time in a systematic way. Let me show you what that looks like with a journal entry, using a lease with payments at the end of each year. Debit lease expense and credit cash for the amount of the lease payment. If it were a finance lease, we would have allocated $24.87 to interest expense. But here we don't have to do that. We can use the amount that would have been allocated to principal to debit lease payable and credit right of use asset. Those accounts will still be zero at the end of the lease, which accurately reflects what's going on here. We're paying rent for an asset that we won't have anymore at the end of the lease. And the lessor, for an operating lease, the lessor's life is easy. The asset never leaves the lessor's books, no receivable, no derecognition, none of the sales type machinery. The lessor keeps the asset and keeps depreciating it just like before and recognizes lease revenue straight line as they receive payments. Rent revenue on one side, rent expense on the other side. Perfectly symmetric and refreshingly simple. Let's work with some numbers. Here, we'll take a 3-year lease at $10,000 a year with a 10% rate, classified as operating. The term is only half the asset's life, and the present value is well under the 90% of fair value, so it's clearly an operating lease. We'll record the inception entry, then build the year 1 combined entry, the straight line lease expense, and the reduction of the lease liability. Let's start with the same lease that we've been working with before, which has a $10,000 payment over the course of 3 years at a 10% interest rate. So the first thing we need to do is calculate the present value of the minimum lease payments, which is done for us here, and that gives us the $27,355. To confirm that this is in fact an operating lease and not a finance lease, we'll take the $27,355 and divide it by the fair value of the asset, which gives us 85%. Recall that the rule is that if the present value of the minimum lease payments is greater than 90% of the fair value of the asset, then we must capitalize it and record it as a finance lease. But in this case, it is not, so it's an operating lease. We still have to capitalize the lease according to ASC 842, but the entries at the end of the year will look a little bit different. We're still going to create an amortization table because it's going to help us build our entries. But what we do not have to do is we do not have to allocate any of this $10,000 payment to interest expense in our journal entries. However, the allocation is still going to come in handy to draw down the lease liability and to amortize the asset so that at the end of the 3 years, we no longer have a balance in lease liability and we no longer have a balance in the right of use asset. The first payment we need to record is actually going to look exactly like the finance lease. We're going to debit the right of use asset, and we're going to credit lease liability for the amount that we've calculated here, the $27,355. And we're going to record the very first payment, which will reduce our lease liability and be a credit to cash. That is the $10,000. The next entry at the end of the year is normally to record interest expense. So I'm going to show you what we would normally do, and then I'll show you how to adjust it for an operating lease. What we would normally do is we would debit interest expense and we would credit interest payable for the amount that's shown in the table above at $1,736. Then we would debit amortization expense and credit the right of use asset. But in this case, since we are not debiting interest expense or amortization expense, what we're doing instead is we're debiting the entire $10,000 payment to essentially what we call rent expense. But we're going to call it lease expense to be specific. So we're going to debit lease expense for the entire $10,000 that we are going to be paying tomorrow on January 1st. So what we would normally do is we would credit interest payable for a part of that, and we would credit right of use asset for a part of that. We do not have to debit amortization expense because we're putting the entire $10,000 into lease expense. We're not allocating it between the two, interest and amortization. But we do have the credit side of the entry. So instead of crediting interest payable, we're going to credit lease liability for the amount that represents the interest allocation. And then we are going to credit the right of use asset for the amount that would be dedicated to principal. So that is our operating expense or our operating lease entry, recording the lease expense for the full amount of the payment instead of allocating it to interest and principal. Then the second payment is simply debiting the lease liability and crediting cash for $10,000 as depicted here in our amortization table. So again, the difference in this entry is simply that we are not separately allocating interest expense. Every single debit to expense at the end of the year will be for the full amount of the payment. The credits will still draw down our balance sheet accounts so that at the end of the lease, they will be zero. To wrap up, operating leases go on the balance sheet just like a finance lease. The days of invisible leases are over. The difference is the income statement. One straight line lease expense instead of interest plus amortization. We still compute the interest component, but the number we need is the amount that goes to reducing the principal of the liability over time. And the lessor never takes the asset off their books, depreciating it like normal. In the next lesson, we're going to close out our discussion of leases with what happens when the end of the lease is uncertain because of residual values and purchase options.